All right. Good morning, folks. It is January 19th, Wednesday morning. I feel like we haven't done the pre-market prep in a while, so let's get back into our groove here. But I hope y'all are doing well. Hope you enjoyed that 3-day weekend we just had. So we got a short week here, but an interesting one. So take a quick look here at the futures, and then I want to show you. I don't want to call them warning signs. I don't like dramatic terms like that, but I want to show you a few things as far as the structure and the trend goes. I think you should at least be mindful of. But a quick look here at the futures, your QQQ, nice little pop here of about 0.5%. Let's take a look at Big Mama S&P. Pretty good bounce here, right? And you got to expect a little bit of bouncage. We're down at like 2 to 3 ATR. The small caps, I think a lot of us right now got a short here. You're up about 0.5% there, and the big Dow. Pretty much the same thing across the board. You get your flush into -2 ATR, it does open the door for potential bounce. Now, my mindset right now is, generally speaking, especially on the IWM, especially on the Qs, I'm looking for a strong bounce, but I'm actually looking to short the bounce. Right? So when you have good trend, you have good bullish structure, particularly to your weekly chart, we're more so looking to buy the dip. Right? But as your daily chart breaks down, and then your weekly chart starts to lose structure, it becomes a bit more of a sell the rip kind of market, where you're looking for those oversold bounces, and then you're looking to short those bounces. So if you look at the small caps here, I think a pretty good visual example. Let me clean a few things up here. Make it easier on the eyes for you. Right. But if you look at the small caps here, you start to trade under your weekly 21. Then you get the shift of momentum, the negative histogram. You lose your stacked DMA, so now you're starting to lose structure. When those kind of things come together, you're looking at something where typically the path of least resistance is going to be to the downside. So when everything is bullish, we're looking to buy the dip. This kind of structure, you're more so looking for a bounce, and then you're looking to short it to the downside. So there's a few spots here I'm still trying to work some long positions on, but generally speaking, small caps and for the QQQ, until something changes in a big fashion, I'm more so looking to short the bounces. Here's a few things to be mindful of. We'll kind of go top to bottom. So if you look at a monthly chart, which I don't think we really ever spend too much time talking about, but there's a lot of realities here. Well, the reality of the last, let's just say 2 years. The reality of the last 2 years is, right, and you can call it the Fed, you can call it the money printer, just in terms of structure and kind of a language we all speak, what really happened here? A big ass monthly squeeze fired to the upside. That's like your ultimate release of energy, right? It's like the biggest gas tank your market's ever going to have. You can see the previous monthly squeeze takes you from December 2016. And it kind of takes you all the way into 2020. So much of that push, right, and so much of what was working last year was working because you're firing that monthly squeeze. So what I want y'all to do is, right, just pretend this is a daily chart, right? Because I think for a lot of us, it's easy to apply these principles to a lower time frame. So just pretend it's a daily chart, right? And taking what we know about the squeeze and trend and reversion to the mean, what's the typical pattern? Typical pattern is you get a daily squeeze. So you build up energy. It's kind of phase one. Phase two, squeeze fires. You release your energy, right? And typically when you're pushing on big time momentum, the AEMA, it's your pit stop, right? It's your momentum moving average. So again, you build up energy, you release energy, all the while you're riding AEMA. Then your squeeze gets tired, right? You slowly but surely start to run out of gas, right? So when you start to get signs of exhaustion, and then you start to trade under the AEMA, typically what is there the potential for around the corner? pull back to the 21 EMA. Those are principles I think a lot of us understand on a daily chart, right? So to look at the market from a much a bigger picture view here, keep those same principles in mind, right? Your last 2 years of price action has basically been a monthly squeeze fire and long. As that squeeze gets tired, if we start to lose structure and trade under the AEMA, you kind of need that healthy pullback to the 21. So in terms of the bigger picture trend here, that's important to keep in mind, right? Again, what worked back here was because of the monthly squeeze. So as that squeeze kind of dies out here, there's definitely some adjustments to be made. Right. Now, one could say, well, we're just pulling back. And, we've pulled back plenty of times in the last, 2 years and change. And every time we pull back, big money comes in and just saves the market. Right? Every pullback is a buyable dip. And I would agree with half of that. Right? We have seen some nasty little pullbacks. Right? So this is an ugly daily chart. And, things kind of get a little sloppy over here. That was definitely pretty ugly. But each of those is getting bought right back up. Okay? So buy the dip, just that buy the dip mentality. And it works pretty much every single time here. Right? Here's the difference right now. Right? That flush and this one and that one and that one and that one. You're pulling back into like textbook picture perfect weekly structure. Right? Like it's not going to get any better than that as far as buy the dip. Your super bullish weekly trend pulls back to key support, gives you the courtesy to kind of sit here for 3 to 4 weeks and let you get positioned, and then the trend continues. Right? So you're pulling back into a really bullish structure. Not so much right now. So now we've gotten to the point where our ugly daily chart is kind of starting to play around here with the weekly structure. Right? We're finally trading well under the 21. You're starting to lose momentum. Right? So just keep these things in mind. Right? Those two things. Why did buy the dip work so well last year? Because your market's pumping on just like crazy momentum, right? From a massive monthly squeeze. And every time the market flushes and it's the market's in turmoil, it's just a pullback to support. It's like the best buy the dip opportunity. So now your source of momentum for the last 2 years, it's getting tired. And your structure on the weekly chart, it's not crazy bearish, but you are losing a little bit of structure. And then as we go through the lower time frames, it doesn't get any prettier. So the point I'm trying to make is just understand the few things that have been, those dynamics at play for the last 2 years. And just be open-minded to making some adjustments in your trading as those dynamics start to shift. Let's be real. For a good year and a half there, it really was, hey, let's wake up. Let's look for a dip. Let's run a scan for some squeezes, and let's just go to the beach. Not so much right now. Now, in terms of, can it still be that easy? Well, I'm running my scans here. And I got like 4 setups, guys. Okay. So that tells me, 2 months ago, there's way too many things on my scan results. Right? We're spending like half of our session in the options room just trying to narrow down the list. Now, here's my watch list of good-looking bullish daily charts. It's MP, still printing buy signals. It's LITE, still printing buy signals. You've got Alcoa. You got earnings here, but a good-looking setup. And then you have Qualcomm, but Qualcomm's going to be a toughie. It's got no wind at its back. And that's it. Qualcomm, MP, LITE, and I am keeping an eye on Lucid. That's literally it. As far as, what's my criteria for a really bullish looking chart? Out of the entire market, there's like 3 or 4 here. That's just my standards. But the point being, 4, 5, 6, 8 weeks ago, there's just too much on the watch list. Right? There's too many good looking setups. So things are changing there. So it leads me to believe there might be a bigger plate of opportunity on the short side. Now, here's the issue with that. At least in the short term, maybe we can get a decent bounce here. You still want to pick your spots wisely. So generally speaking, if you're getting long and you're getting long, at 2 ATR, it's kind of a shitty entry, right? Same principles apply. You're getting short down here in the hole at -2. I mean, if you're scaling into a short, that's one thing, but you're probably going to have to sit through a pretty big bounce. So we're still trying to apply the same principles, right? We're still looking for moves into, I'd say, -2 ATR to the downside. But we're trying to take our entries as close to the 21 EMA as possible, just like we're doing to the upside. So in terms of, my trying to get long here, if it's a good structure, and if I can pick my targets and the risk reward between the targets makes sense, then I'm all about it. But in terms of where is there probably going to be more opportunity, unless a lot of things change here, and I'm talking your QQQ has got to start closing back above the 21 EMA. That's just kind of step one. Otherwise, let it bounce, and then I'm going to short it. And what I'm doing right now is, if the path of least resistance is going to be to the downside, the pattern is going to be we're going to flush, right? Going to get a pretty good bounce. Then we should come in and at some point tank out the recent low. Right, so I'm waiting for those bounces. So on IWM here, we got that little bounce. So what I'm doing is I'm selling the in-the-money call credit spread. Right, I'm shorting the 208 call. Come on, damn it. You little bastard. Right, I'm waiting for a little bounce. And then I'm trying to short the calls. Right, basically right down at recent support. What this does is it puts you in a really good risk-reward position. Right? So for example, I think, in our trade right now, we're risking about 2.5%. And if we get the flush here, right, and you get that move down to 200, we're going to make about 4 or 5%. So low risk, high reward. And if you do end up getting in a market where the path of least resistance is to the downside, say for, even just for a month, you kind of keep rinsing and repeating there. So moral of the story is I'm waiting for a bounce to try to short a few things here. And if I'm trying to get long, it's got to look like this. Not like this. So I'm being really strict with what's on my watch list. So I had autos on the watch list. Yeah, I don't like it anymore. I'm losing my buy signals. I don't have any interest. Not in this market. So gotta have the buy signals. But that's pretty much what I got for y'all here. Right? A bit of a bigger picture view. There's some things to be mindful of. And then in the short term, it's just a question of what's the path of least resistance. I'm seeing some things right now that kind of point towards it could be to the downside. So just kind of remove some of that unnecessary fear associated with a quote unquote bearish market. Just kind of think more in terms of average true range, right? We should probably care less whether it's to the upside or the downside. Pick your spots wisely, take the higher probability move, and just rinse and repeat. Then if things kind of shift course, you just start doing it on the opposite side. But that's what I got, guys. So if you got any questions, anything you want to take a look at here as far as charts go, if I'm missing anything as far as good looking, pretty daily chart action, I'd like to see it. Actually, while I got you here, while I've got you, let me run this scan and just make sure. Yeah, I am missing one. SO. So here is looking pretty clean. So I think we talked about this last week or maybe a few weeks ago. As the market shifts, right, and this certain dynamics kind of change here, you got to kill those biases towards your quote unquote favorite stock. Right? So I've got my favorites. I got a soft spot for Google, for example. Google looks awful here. But if you look at the last few weeks, right, there's DWAC. really don't care what the company is. Give me a bullish daily squeeze. There's been names like, there's a lot of them, right? There's SO here. Never heard of it before. But that's a good looking chart. So just be super, super picky as far as where you're putting on exposure to the upside. But let me see, scan results. Yeah, Qualcomm, Southern Company, Alcoa, MP, LITE is just about it. Just about it. Hey, good morning, good morning, good morning, y'all. Good question here, Lewis. Low liquidity can be kind of work in your favor. It can also work against you. That's a really good question. It's a really good question. Here's what I think you want to focus on. At least for me, when I'm selling the spreads, right? What I'm really focused on is the spread itself, because that's part of the dilemma I'm having right now. A lot of my scan results, these random ass names, right? Like things I've never heard of. So some of them do start to kind of creep into the territory of the spreads are kind of trash, right? The volume's weak. There's just no liquidity. It can get a little bit tough. So typically, the first thing I'm looking for is, say I'm going to sell a credit spread. I want to make sure there's, if bid and ask is $1 by $4, I'm just going to move on. Something might be a little bit low liquidity, but if I can still work a good tight spread on the entry, then I'll play ball. But that's a good question, though. I am seeing a lot of that right now. Like, hey, here's a good chart. I just can't play it with the options. Seeing a lot of that right now. I saw an Amazon question. Hey, good morning, Michael. Do I think Amazon hit support in its channel? It's been trading. Let's take a look. Yeah, she's range bound. That's for sure. Let's take a look here. I mean, you could really look. I mean, so it's big picture, right? Just kind of give this thing a few years here. What's that? 3780-ish. So from a really kind of bigger picture perspective, right? Taking the range of the last 2 years, your bottom end is kind of down here at, let's just call it 2,900. Now, the reason that I point that out is if you look at the structure of the weekly squeeze, I'm not saying it's going to fire short, but it's kind of got the characteristics of maybe it wants to. So that's the only reason I bring up your true bottom end support might be a bit closer to 2,900, right? Because you do have a weekly squeeze under the 21, now trading under -1. You've lost your stacked DMAs, histogram's negative. So just structurally, there's a potential here it could flush more. Yeah. I think with 2,900 being around, big number, right around -2 ATR, at least just have that in the back of your mind. Could be another couple $100 to the downside. Now, what I would say here is if we can start to see signs of exhaustion, you get a nice relief bounce here, right? Momentum starts to shift a little bit more bullish, then we might be working this more recent range. Just keep in the back of your mind, bigger picture perspective, 2,900 might be the real bottom end here. So I really think it's a matter of what does this weekly squeeze do? Is it kind of pull one of these where it's flirting with the idea of firing short? Then it just kind of holds up just fine. Or do we actually start to roll over? If we do, I'd actually look for my next entry, probably down at 2,900. So good question there. Good question there. Good morning, Phil. Yeah, Phil, good call out here with Pepsi. This is what I'm talking about. In terms of, in my own trading, I've got to kill the biases. Right? Like, look at that. Little dip to the 21. Now, the key is I'm looking at this in advance, right? That's why for me, as I'm running my scans more and more, I'm not going to just glance over Pepsi. I'm going to spend a few minutes here. My buy signals are saying, dude, spend a couple minutes here. All right, so we're in a squeeze. We got stacked DMAs, green 10x bars everywhere. I should be waiting for that dip right there, because now you're sitting on a great trade. So I think good structure, and quite frankly, you're kind of in the zone here. Yeah, solid. Now here's where you work a good risk reward, right? I look at this as a continuation trade, right? Always take things to the weekly chart. You're going to get a good perspective of, where am I at in the stages of the trend here? You've already fired your weekly squeeze, so the party has already started. So keep in mind, as that weekly chart's up here at 2 ATR, you're fighting in the background that growing probability at some point here. We got to come back on down to home base. So you're fighting that in the background right now. So I think what you do here is you take that bullish daily squeeze with a tighter stop. And I think a close under the 8 EMA here on the weekly chart, it's a great exit. Maybe it shakes you out, but guess what? You close under your 8. It's the same discussion we're having about that QQQ monthly chart. You build energy, you release energy, typically into +2. And if you break your 8, you're probably coming back home. So I think it can work a nice risk reward here. So Pepsi's very solid. Right? It's a great trend. It's a great trend. I'm sorry, IBM. What am I doing looking at XLB? Oh, nice, Phil. God, I hate earnings season. Great structure, though. Right. So let's get some trend context. Okay. Right. We're more so right here. Right? In terms of, buildup of energy, release of energy, IBM is much more in buildup of energy, very much like back here. Right? So again, my proposition is once that weekly squeeze fires, you're going to use that trailing 8 EMAs on the weekly as your stop. Because if you lose it, you're a bit prone to the reversion to the mean. This is a lot more consolidation. So I think what would be solid here, and let's just pretend earnings, isn't in a few days here. Yeah, I like that. You take that daily squeeze. You can work a target into maybe 140. And I think you're open-minded here to closing it on the close under your weekly 21. Because put it this way, if you get under your weekly 21, do we really think that daily squeeze is going to explode to the upside? Probably not. You start to trade under the launching pad. So that's a good-looking daily chart, Phil. A couple of good call-outs there. Let's see. Jesse Jones. I'm not sure if you're saying good morning or you want to look at General Motors, but good morning to you, and we'll look at GM here. Give it kudos. It does hold up a lot better than a lot of names in the market here. No daily squeeze. Is it my favorite setup right now? No. Can you make the numbers make sense? If you take an exit on a close under the weekly 21, you're going to work a really good risk reward, even if your target is just a bounce into daily +1. Point I'm trying to make, though, is especially in this market, we're looking for short-term momentum. And one of the first signs that you ain't going to get your short-term momentum in your favor is you start to break your weekly moving averages. Now, do we run the likelihood of getting shaken out of more positions? Sure. I think we should care less if we're going to risk $100 per contract to potentially make $300, $400, $500 per contract. Right? That's the name of the game in this market. Having the willingness to take more losses, more frequent losses, having the willingness to get shaken out more, but you're dramatically working the numbers in your favor. I think we want to aim to put ourselves in a position where even with a 40, 50% win rate, we're still growing the accounts this year. And then my argument would be, hey, if we can be disciplined and laser focused, I still think with the right setups, we can clock in on that 70% win rate this year. But you got to think in terms of numbers, right? The days of, I'm going to wake up, I'm going to run me a quick scan, I'm going to buy me some calls and go chill. I think done and over with. And I won't be complaining here if I'm wrong. But all things to keep in mind. My brother, MGM. I hope you're doing well, my friend. Always good to see your name. In my opinion, right, Microsoft versus MGM, not even close. If we're looking for a long position here, this is in a daily squeeze at the 21 with stacked DMAs. Microsoft takes a pretty good whooping. So good structure here, right? Good structure. Momentum is a bit neutral. However, that tends to be the case early in the consolidation. So now what you're looking for here is kind of, from the very bottom to the top, and you can look at the histogram. Does momentum all start to turn bullish? Let's look at a weekly chart here, get a little bit of context. Yeah, you're right at your weekly 21. So good structure here. Typically, I'd ignore it, because it's not Tesla, it's not Amazon. Yeah, that was a great push. So I probably shouldn't be ignoring everything anymore. So good looking setup there. Good looking setup there. Let's see. What's my opinion on iRobot? What's that ticker? Oh, look at that. I nailed it. Oh. Just based on my tools and my rules, I'd probably only look to short it. Now, for what it's worth, I don't think I'd actually want to do that in the short term. Because if you look at your daily chart, it's taken a while here, right? But these are things to pay attention to. This has spent the last, 2 months here, fully shifting momentum. Bearish momentum. Everything starts to turn neutral. Now he's trying to pick up a little bit here. So does that mean you could get a nice short-term bounce? I do think so. Just keep in mind you're in a downtrend. So what I would actually look for here, and it could be a great trade, is because you got that full shift of momentum to your daily chart, and you're kind of down here at -2 ATR on the weekly chart, could be setting up for a bounce back to the weekly 21. I think the risk of reward could be great here, right? I say you exit on a close under the recent low. And if you give it time, it could be working a target up into 75. So, just in terms of points, we're risking what, $2 for a potential $10 move. You do a credit spread, you do a debit spread, you buy calls, the numbers are going to look really nice there. So that's my thoughts there. Bigger picture, it's a nasty downtrend. With a full shift of momentum to your daily chart, could be gearing up for a weekly bounce. So the risk reward there could be pretty solid. Pretty solid. All right, my brother, what you got here? OPK? Right, solid. Very solid. Never heard of it, but that doesn't matter. If the options are good and healthy. Stack DMAs, green 10x bars, everywhere. Weekly 3-day, daily 4-hour squeeze. Okay. Good stuff. And I'm getting buy signals. So Tim, you're pretty good here at nailing these buy signals. You're getting pretty good, man. Let me see. Good question here. How we doing on time? We're doing good. Where do I think the bounce ends for the IWM and the SPY? So the cues here. Just taking a quick look. But for the IWM or for the S&P, Here's the way I look at it. In the short term, if you start to get solid closes back above the 21 EMA, you might be wrong on your short. Now, if you want to take it up a notch, and this is typically my preference, I'm going to say, okay, I'm going to give it a bit more wiggle room. My exit here is going to be a close above the weekly 21. Now, here's what I like about this, right? So, yeah, last week we're getting short the small caps, right? With our risk management game plan to be, we're going to take an exit here if we close back above the weekly 21. Right? Now, what I like about that is if everything continues to grind lower, look what's happening to my trailing stop here. Right? The weekly 21 now serves as my trailing stop. So last week, my stop is at what? 222-ish? Now it's closer to 221. Next week, it might be closer to 220. I like giving my swings that wiggle room. I'm dead wrong here in the short term if this fully reverses and closes back above the weekly 21. I'm just wrong. So now my only goal is, all right, if I'm working a target to the downside of, say, $200, and I'm going to, call uncle at 222, 221, 220. Now my only question is, based on where we're currently trading, can I take an entry here where the risk reward makes sense? And at this point, this is why I wouldn't short again. Not down here. It's probably going to be difficult to do a credit spread and do a debit spread where my profit down at 200 is going to exceed my loss up here at 220-ish. You want to work that trade as close as possible, right? So my answer would be, where do we short it? Kind of give it an entire zone. Okay? So my suggestion would be, hey, I'm cutting it loose here if we get a weekly close back above the weekly 21 EMA. So now all I care about, right? Are we trading at 210? Are we trading at 213, 215, 216? The closer, the better. But I'm going to wait for a strong enough bounce here where I can structure a trade where maybe I lose $100 per contract on my loss, but I might make $200, $300 per contract down at 200. So I'd say the neighborhood here is probably anywhere back, near your 8 EMA, just 214-ish up to 220-ish. The closer, the better. Hopefully that makes sense, though. Does this where we're currently sitting, does this offer me an entry where I can work a good risk reward? In terms of options pricing, it gets difficult down here. You want to sell a call credit spread, well, there's no premium left, right? The calls got smoked. You want to buy puts here? Well, the puts are crazy expensive. The bounce not only allows you to work a better risk reward, you're getting a much better cost of entry on your options trade. So I'm looking anywhere from, 214 and higher. But that's the most important thing. If that's going to be my exit, and my target's down here at 200, what's the risk reward look like where we're currently trading? That's the way you want to look at it. Let's do this. What's up next? Good questions this morning. So for MU here, all right, you're looking for MU puts. All right, so for what it's worth, this is a really good-looking daily chart. Now, also for what it's worth, the indexes keep wiping out the lows here, then down go a lot of good-looking charts. Micron probably no exception. I'd be careful about shorting at the daily 21 EMA. We still got some bullish characteristics here. Weekly and daily stacked EMAs, weekly and daily bullish momentum. So I'd probably wait for a crack there of the 21. However, I think we can get a bit more context here from the weekly chart. Right? Ebbs and flows. Just ebbs and flows, right? The textbook stuff. We squeeze, so we build up a bunch of energy. We release energy. And as soon as we start to lose some momentum here, and remember, it happens to your lower time frames first. But as soon as we start to lose some momentum, and you take out that 8 EMA, probably coming on into the 21. Build up energy, release energy, and as long as you got that gas tank, you're riding that 8 EMA. But then you run out of gas, and as soon as you start to trade under the 8, pretty good chance you're coming in. That's how I would look here at Micron. Respect the fact you have a really strong daily chart, but also look at it from that weekly perspective. If we're losing steam here, we take out the 8, you might have a short down into 85-ish. So that's what I would base it on. Just keep in mind, that should be key support here if the trend is going to continue in the short term. So I'd really wait for the crack first. Really wait for it to break down first. Michael, how about XLB? Yeah, so actually talking about this with a buddy this morning. I like the weekly chart. But in the short term, this is where you want to see it hold. Right? Your weekly 21 EMA. So you do have good weekly structure here. I'd kind of call it neutral at best. Kind of looks neutral at best. Your daily squeeze is losing a little bit of steam, but you're decently structured here. You have stacked EMAs. I'd be a little bit patient. However, a lot of you are familiar with, Sam from the options room over at Simpler. Hold on, let me pull this website up. He always says something along the lines of, well, is there something, is there a stock in the group that's cleaner than the group? Right? Is there anything that looks way better than XLB inside of XLB? So if we do that kind of thinking here, let's go through the list, right? Does anything look better than this? Anything offering a bit more edge? Well, first is LIN, right? Most heavily weighted stock. Well, that's not pretty. Right? The head honcho here is firing a daily squeeze to the downside. So that's not ideal. Sherwin-Williams is the second most heavily weighted stock. Kind of looking a bit sketchy here. Next up is APD. That looks like it's going to fire a squeeze to the downside. So what we're seeing here is the group itself, I would call neutral at best. But the major components in the group, they're looking pretty sketchy here. Then there's Freeport. Freeport looks dramatically better than the group and those top holdings as well. So maybe I'm going to come in here and look for a shorter term trade. Right? This is in trend. It's in motion. Maybe I'm trying to take that 60-minute squeeze off the daily 8 EMA for a nice little pop. But the point being is this looks a lot better than the group itself and the more heavily weighted stuff. Also in the group is MP. So I think with the major, the major players in the group, all kind of looking a little bit rough. And then just the basket itself, just I think looking decent, if anything. I'd say you take the route of, let me focus on Freeport. Let me focus on MP. Right? So imagine XLB looked like MP. Well, I think we can just buy XLB and keep it simple here. Not quite the case right now, though. So some food for thought there. Let me see. How's PPG looking? Yeah, these kind of look more, a little bit suspect, as the kids would say. Let me see. I do like the weekly chart, though. So that's kind of the dynamic right now. You get a few looking really sharp, and then everything else is just kind of lingering here at your weekly 21. So now it's a matter of, okay, do we start to see momentum kind of turn the corner? If you start to get bullish momentum coming in, this actually might be a pretty nice spot to scoop up, again, low risk, high reward. Okay? You can make it as strict as, hey, if we close under the weekly 21 EMA here, I'm out. I'm done. So your risk is what? Like barely anything, about $1. Even if you take the modest bounce into +1, right, you're going to work a great risk reward here. So we'll see how that weekly chart holds up. Now compare the weekly chart here to the weekly chart in XLK. I'd probably be getting out of XLK longs right now. I'd probably be holding on to the XLB longs. Because it's doing a good job of holding support where it should hold support. Okay, it was good morning, not GM. Good morning to you as well. Yeah, Robert, thanks for bringing this up. Keep this in mind as well. Friday's monthly expiration. So there's pretty good chance here they might just chop this thing to death, right? Let's rope them into calls. Let's rope them into puts. And all said and done, let's just take them nowhere and wipe the floor clean with them. Always that potential heading into monthly expiration. Always that potential there. But all right, guys, listen. It is 9:27. Mama Market opens up here in 3 minutes. So I'm going to cut you loose. I think I got, let me see. For those of you over in the options room, I'll be in there at 9:30 Central, and we'll see what today has in store. But hopefully y'all found this helpful this morning. I think as we go from, again, top to bottom, there's just some things to be mindful of. Right? So be flexible, I think, especially for the swing traders. Have no bias towards the path of least resistance. If the indicators, if the momentum, if the structure points towards it, might be to the downside. We're just trying to operate in that direction. Right? Good entries, good exits. So enjoy the rest of your day. Go kick some ass. I'll talk to y'all soon.